The economy is far weaker than is generally understood. I realize that the active marketplaces on recession predictions have fallen way off. I would bet against that. I think the recession risks are better than 50-50. I believe that that's being confirmed now increasingly by the hard data, and that the economy has a very difficult walk here ahead of it. And the revised national income and product accounts for the first quarter show significant deterioration in my aspect. One of the things that economists like to look for is to compare what's happening to GDP and GDI, gross domestic product, and income. So we now have the first estimate for GDI, and it declined 0.2% in the first quarter. And to me, it's more meaningful when they're both lined up than when they diverge. When they diverge, one has to try to figure out which is more reliable. But in this case, we don't. Another very critical aspect of the first quarter is that the Bureau of Economic Analysis is showing that consumer expenditures were far weaker in the first quarter than originally reported. They grew only 1.2%. That's a downward revision of 0.6 of a percentage point. And in my view, it's not surprising, because I think the consumer is under pressure, and the consumer loan rates are really not affordable, and they're not reasonable. In addition, the consumer, we've seen the serious delinquency rates on credit cards jump back to where they were in 2011. Same true for automobile loans. We're now beginning to see a rise in mortgage delinquency rates. And with the student loans now due, a massive increase in student loan delinquencies. And so the consumer is under pressure. Another very important aspect of the first quarter is that there was a massive inventory surge. Now, the inventory surge was part of the buy in advance. So when President Trump was president-elect, and he announced he's going to raise tariffs, there was a great buy in advance. And the impact of the buy in advance had its tentacles all over domestic and international data for November, December, and even into the early part of May. So firms went out and they bought imported goods, brought them into the country, caused the trade deficit to balloon. It'll be reversed. But the side aspect of that is that there was a huge buildup in inventories. Inventories are contributed 2.6 percentage points to GDP growth. So in the first quarter, a big jump in inventories at a time when consumer spending growth was coming down. And the indications that I'm seeing based on limited returns so far in May is that if the consumer is still exhibiting this same kind of difficulty, and firms now have to move this inventory. They don't want to hold it, and that's going to present a problem. And the third aspect of the numbers today, and this is going to really surprise people, and those that are invested in the stock market should pay a little bit of attention to what I have to say. The stock market, of course, focuses on the S&P earnings that come from the companies. And as you know, the critical thing here is whether the reported numbers beat or lose to the street. Right. So we say beat the street game. So if you whittle down the earnings estimates and to a very low level, and the final numbers come in better, you beat the street and you have a great positive reaction. But the numbers from the Bureau of Economic Analysis for corporate profits, in my view, are more reliable, because what they're doing is they're relying on the income tax payments to the IRS. And so if you jigger with those numbers and you understate them, you can lower your taxes, but you can also be subject to civil and criminal penalties. And so the BEA is saying that there was a very significant fall in profits in the first quarter, more than $100 billion, 3.6%, not annualized. In fact, the drop in earnings reduced more than half the gain that we saw in the fourth quarter. And that's not surprising, because a lot of the domestic demand was really centered in very few sectors. Consumer spending was weaker, not only in the service sector, but in goods. Non-residential fixed investment declined in the first quarter. Residential fixed investment declined. The strength was really in two categories of equipment spending. One was there was basically 9 months of automobile planes were delivered in the first quarter, rather than the normal 3-month delivery, because there'd been a series of strikes. And so the aircraft deliveries were very robust. And then, of course, there's this phenomenal rise in the artificial intelligence in the data centers. A lot of the critical, advanced, leading indicator sectors contracted, and that goes hand in hand with deterioration. Certain components of the economy, very few did well, but it was not enough to offset the weakness elsewhere, and corporate profits drop. And so the underpinnings of the economy, and this is very hard data, are certainly flashing yellow and possibly even red. Another indication is that we're continuing to witness this upward creep in both the initial unemployment claims and, more significantly, in the continuing unemployment claims. Now, it is true that the new claims remain relatively depressed in terms of historical comparison, but they're gradually edging upward. More importantly, the continuing claims were the highest since November of 2021. And so while the layoffs haven't jumped significantly, people are not being recalled. I think that is a significant development, and it goes hand in hand with the job openings data, which have continued to decline. So the economy is exhibiting increasing signs of pain, and there's no real stimulus coming in to offset it, at least for the near term, as far as I can see. I have felt for some time that monetary policy is too restrictive. As you know, I like to look at the 4-year moving average of detrended money supply. I prefer to take out the money market mutual funds and the currency to get a better cyclical measure. That's continuing to decline. So monetary policy is too restrictive. So monetary policy is not moving to alleviate these weakening signs, which increases the odds that they're going to gain momentum. Now, some people will say, well, we have the big, beautiful bill, the quote tax cut. I've studied that bill pretty closely. This big, beautiful bill is not a tax cut in any significant way. It's a tax extension. Yes, there's the elimination of taxes on tips and overtime, but that's a very small thing. There's a credit for some low-income recipients of Social Security, but they didn't actually reduce the Social Security tax rates. There are some corporate benefits that extend in later. So to my way of thinking, the big, beautiful bill is really not going to have much of an impact if it passes the Senate in the current form in terms of the budget deficit as a percent of GDP for 2025 and 2026. And it's quite possible, and again, here we don't know because the tariffs have been ruled unconstitutional by the trade court. We don't know whether that will be reversed. Also, I might add that the Trump administration has additional legislation that they can use. They could have used the Section 120 of the 1974 Act, in which the only criteria is that the country be running a trade surplus against us. They could have imposed the 15% tariff. I calculate that we had a 3% tariff prior to all of the actions by the current administration. And I was assuming that after everything was done, we would probably have a 12% tariff. By the way, a 12% tariff would take us back to where we were in 1941. I don't see where that really changes that much. And I calculate that if you had a 12% tariff versus 3, the revenues are about $300 billion a year, a little bit more than $25 billion a month. And if you combine the tariff impact with the budget actions, and keep in mind the tariff actions by the administration are not picked up by the CBO calculation because the Congress is not the source of those revenues. So if you pick those revenues up, basically whatever mild net boost to GDP that might be in the big, beautiful bill is erased by the tariffs. There's no impact, as far as I can tell, of any stimulus coming from the big, beautiful bill. The debts problem is so big, the House did what they could to take care of some of the campaign promises, which really weren't that expensive. Eliminative taxation on tips is not a big item. My sort of feeling is it's no more than $50 billion a year. When you've got such a huge deficit as we have, that's really a rounding error. My recommendation would be that there had to be much greater restraint on federal spending. Now, there is some because they tightened up the Medicaid requirements and the supplemental nutrition requirements where there were clear evidences of fraud, and tightened up the likelihood, as I understand it, of what payments are going to those that were not eligible for Medicaid and so forth, things that are certainly important to do if we're a society of laws. And then, of course, there were significant cutbacks in green energy, which were part of the Inflation Reduction Act, things that had also been a promise during the campaign. And so the bill, in terms of the impact on the deficit of a percent of GDP, is very small. And it's also, we have to understand that it's under the ceteris paribus assumption that economic growth continue at 2%. If you have a recession, which I think is a better than 50-50 risk, then the deficit is going to go up 2% of GDP. So you wouldn't stay at 5, you'd go to 7, you never even see the improvement. And that's why I personally have thought that monetary policy is too restrictive. And the Fed thinking that that they're in a good place, they're not in a good place. And the economy needs the support of the Federal Reserve, and it's not forthcoming. And this is an important lesson of macroeconomics. The trade deficit or the current account deficit or surplus, whichever the case may be, is the inverse of the capital account. So when a country runs a large current account deficit, such as we do, it means that people have to take our IOUs. And so we have a capital account surplus. And so funds from overseas are being invested in the United States. And as a result of the accumulated deficit, the foreign sector, according to the latest numbers, has about $18.5 trillion invested in the stock market. It has about $4.5 trillion invested in corporate debt. So $23 trillion is in corporate paper. It has about $7.25 trillion invested in U.S. Treasuries, and it has about $2 trillion invested in agency paper. In other words, so if these programs are successful and they lower the trade deficit, they will simultaneously lower the capital account surplus. If you go back and if you look at the period of the 1920s and 30s, when we had beggar thy neighbor policies, which were not only tariffs, but depreciations of currencies when they were on a fixed exchange rate standard and other things, international trade came down and international capital flows came down. So when you try to influence the trade sector, you adversely affect the capital account surplus. And right now, people assume that that would be devastating for the treasury market, but they haven't looked at the data very closely. The foreign sector has $18.5 trillion invested in the stock market. It's up over $5 trillion just in the last year, and they have $7.25 trillion invested in treasuries. You disturb the trade surplus, you're going to disturb the capital flows. So this year, simultaneously, what's happening is international trade is coming down and international capital flows are coming down. And I don't think that's helpful.